Well, good afternoon, everyone, and thank you for joining us this afternoon in the third of our series on Financial Literacy Month. As you can see, I'm not Lisa Cordero. My name is Michael Trickla. Lisa, unfortunately, is feeling a bit under the weather these days today, so she was unable to give the presentation, which is too bad because she's an excellent presenter, and it would be good to see for members out in Eastern Ontario to see Lisa present. So hopefully we'll get her the next round of presentations going forward, and we wish her well. So today we're going to look at life stage planning, and really we're going to look at pretty much all the stages of planning, because planning is important no matter what stage you are in life. There are priorities that we have at different points in our lives. You may be planning for a child's education, you may be planning to purchase a house, you may be planning to retire. These are all things that we look at through various stages, and these priorities also change throughout our lives, and sometimes they run concurrently and they compete with each other. So today we're going to cover off some of the more popular parts of planning in different stages of one's life. And what we'll do at the end, we'll save your questions till the end. We'll open up the lines at the end of the presentation, and we'll answer any questions that you have. So with that, let's get started. So today, the objectives of the presentation is we're going to look at assessing your financial position. And this is really taking stock where you are right now. One can look at, this can get very complicated for a lot of people, but the best place to start is where you are right now. So we take stock in our financial position, then we look at credit and debt management. And credit and debt management is one of those things that we can control when we're looking at financial planning and at various stages of one's life. We'll look at saving for an education and some of the tools and strategies that are involved with that. And we'll also look at retirement, some of the tools and strategies that's involved in doing that. And finally, at the end, where to go for more information, because we're going to give a very high level presentation here today, and by no means is it an exhaustive presentation on the material that one can look at through planning for one's financial well-being. So we're going to give some information where you can go for additional information. So the first part is it makes no sense to start at the beginning. Assess your financial position. This is getting a lay of the land, really, and where you are right now. So there's two places really. There's really two principles that one can look at for assessing one's financial planning. It's essentially cash flow and net worth. Now, the interesting thing is most financial institutions, when they're looking at you to judge your financial health, they'll be looking at net worth. That's kind of the more important one to financial institutions. On the other hand, we as individuals, because we have to meet our day-to-day expenses and we live in the like, the more important one that we deal with on a day-to-day basis is cash flow, having enough money to meet our expenses on a regular basis. So, if we look at the components to cash flow, and we look at these separately, there's really two components to cash flow: income and expenses. If your income is greater than your expenses, then you have a positive cash flow. You have a bit of a surplus. And that's a good thing, because cash flow is really the engine that drives net worth. Now, if you have a negative cash flow, so where your income is not as great as your expenses, you have a deficit there. And, that is something that has to be addressed, because you cannot really build a net worth if your expenses are greater than your income. So you have to look at your conduct a cash flow statement, which is a bit of an eye-opener, and then create a budget from that. Now, for a lot of people, budget there's a connotation with the word budget that brings up a lot of negative emotions. That means, cutting to the bone, not having the things to enjoy one's life, but that's not necessarily what it means. A budget is really taking stock of where your money is going. And that's all it is. It's just a document that shows, what's coming in and what's going out. And that's all that is. And then one can look at your financial situation from that point of view and make some sound, smart financial decisions that make more sense for you. Now, if we turn to the other part of your financial position, we're looking at net worth. And net worth is essentially assets minus liabilities, what you own versus what you owe. And again, if you owe more than what you own, you have a negative net worth. But if you own more than what you owe, then you have a positive net worth. Now, net worth is, again, net worth is just a snapshot in time. It's what your position is at that particular moment. So one's net worth could be flat, one's net worth could be growing, or one's net worth could be declining. But growth in net worth, really where you have the greatest control in growing your net worth is by cash flow. So getting control of your cash flow is really important to how you drive your financial well-being going forward. And again, we want to look at making these decisions on our terms, right? So let's drill down a little bit further into this. Now, if we look at cash flow, and we start with cash flow, the first thing you want to do is divide your cash flow into two sections. You have your non-discretionary cash flow items. These are the ones that are really the non-negotiables. Debt payments, mortgage payments, food, clothing, transportation, utilities, insurance, taxes. There's really no wiggle room on this. These are the things we have to pay. And what we've seen over the last year or so, and maybe a little bit longer, a lot of these have really increased and taken more of our cash flow. Food has gone up exponentially. So is clothing, transportation. With interest rates have increasing, sometimes mortgages and rents have gone up. Utilities, even for that matter. I looked at my energy bill lately, and I really compared it to a year ago and the like, and it's just astounding how much this has gone up as well. We really can't control these things. These are outside influences that we really have to maybe build a buffer in for, because they do happen. But at the end of the day, there's really no wiggle room on these expenses. Then there are the discretionary expenses. These are the ones that involve personal spending. So, cell phone, travel, cottage, vacation, property, gifts, entertainment, hobbies. The list goes on, and everyone's list is pretty much different. These are the ones that you look at and you say, okay, these are the ones where you have the most adjustment that you can make if need be. Now, there's a lot of stuff that goes on in the financial planning industry, and everyone, I'm sure everyone's heard this analogy before that somebody at some point in time has made in front of them. Well, if you cut out that 1 cup of coffee a day, or that latte that you get from Starbucks that really, and put that towards saving for, your retirement or whatever, over time, that's going to add up to some enormous amount of money. But you know what? Let's put it this way. For some people, maybe that latte is the highlight of their day, right? So that's really a non-negotiable expense. So this is why I say these lists are different for everybody. Yeah, sure, you can cut that out of your day and you can live to the bare bones, but what's the quality of your life going to be? So there's always that trade-off between quality of one's life and certainly what your obligations are. So it's not really a zero-sum game where one side wins over the other side, that you have to really do all these the saving for retirement or savings for your children's education or what have you at the expense of other things. In many cases, you can do these things concurrently, but it involves setting down the right strategy, and you can't set the right strategy until you've kind of done this process and just identified where the money is going. So, I said a lot of things, and I said, okay, well, managing your cash flow, probably one of the most fundamental place that you can look at is credit and debt management, because that's really where you have the most impact on managing a lot of where your cash flow goes. So if we look at borrowers in Canada essentially have two types of credit or debt that they can take on. They can take on fixed credit, and they can take on revolving credit. So fixed credit are things like mortgages, personal loans, car loans, and they're called fixed because they're borrowing for fixed amounts with a fixed term at an interest rate that generally is also fixed as well. In some cases, you can get variable rate mortgages, but for the most part, everything is set in stone when the debt is incurred. And to kind of break that deal, it's either impossible, or if you can do it, it can be very costly. So for all intents and purposes, these are fixed credits. Can't really do much about those when you're looking at cash flow going forward, but you can look at your revolving credit. Your revolving credit has a little bit more flexibility to it. So these are things like overdraft protection, credit cards, unsecured lines of credit, or even secured lines of credit for that matter, where the borrowing amounts have limits set to them, but you don't have to access those if you don't need to or want to, right? And these can be also looked at and to see how they are and to see if the terms make the most sense for you. So when you're looking at your cash flow going forward and you're looking at borrowing, there's a couple of things that every financial institution looks at before they advance credit to somebody. And you may have heard the term the 4 C's of credit. Well, the 4 C's are basically judging what kind of risk that you are. So these are things such as character, capacity, collateral, and credit. So when we look at character, we're examining the individual's reputation for repaying their debts and managing their affairs prudently. It's very easy to just sign up for every credit offering that's out there because they're offering you a balance transfer, or they're offering you some dividend cash back, or they're offering you some sort of points system or that sort of thing. There's a ton of offers that are tied to credit cards, and it's very easy to kind of accumulate these. So you have to be very prudent when you're looking at credit cards and the like, to make sure that you don't give the impression that you're managing your affairs imprudently. There's also capacity, your ability to pay your current obligations as well as the one that you're applying for. Do you have the capacity to take on more credit, right? This is very important in judging your risk too as well. Collateral. How much are you using as security on the loan, right? If you're borrowing for a car, or you're borrowing to purchase a house or a property, that matter, generally that's the collateral that's on the loan. But there's other types of collateral that people can use on loans too as well. Life insurance policies, securities, that sort of thing. And really collateral kind of reduces the risk to the loan. So if the person doesn't pay, there's something of some value that can be sold in the market that can offset the loan itself. And finally, there's credit, your past and your current credit history. Every financial institution wants to know, is this guy a good risk, or is this a girl a good risk? They really want to see what that looks like. So to do this all, because it's so easy to get credit and because there's so many financial institutions out there, what's happened is we've looked at what's happened is we've had credit rating agencies such as Equifax and TransUnion. What they've done is they've compiled all this data together, and they've quantified it into a credit score. And this is all the data that's reported by any business that's given you credit. Not all creditors are part of the submit their debts to credit reporting agencies, but most of them do. So it's important to make sure that whatever you have, anybody who's advanced you credit is also you're taking care of that in a prudent fashion. So if you're looking, so the credit scores rank between 300 and 900. Anything less than 600 is considered a high risk. You may have had a history of looking at delayed payments. You may have a history of even defaulting on credit cards in the past. That's all going to, or any credit card for that, credit for that matter, that's going to detrimentally affect your credit score. Anything between 600 and 700 is what's considered credit worthy. That's essentially saying, you know what, to the financial institution, this person can take on more credit. They've met all the satisfactory requirements of those 4 C's. And although there is some risk involved in granting credit, nothing that's really out of line here. Between 700 and 800 is good credit. It's a good credit risk where people have more capacity to take on credit, and they have a history of paying making their payments on time and keeping their credit balances low. And anything over 800 is excellent credit. These are people who have very little debt on their books, or any debt or no debt for that matter, and any advancement of credit is pretty much a low risk. So, what one sees here is essentially that it doesn't mean if you're below 600 you'll never be able to get credit, but it may be very expensive to get credit. And for somebody who's in the area of 700 and above, that may be somebody who really is able to negotiate for better terms of credit going forward. But it's important to keep your credit score as high as possible. So how do we do that? Well, to maximize that, make your payments on time. Put them in a calendar, and many of us, we get so busy throughout our day-to-day lives, we forget things. We forget, and if we don't put them in a calendar or in our phones or the like, we don't get those things. Just don't get done. So make it a habit to put your payments in on time. Even though the credit granting agencies do give you some sort of grace period of a day or so sometimes, it's still, you don't want to get them so late that they report that to the credit bureaus themselves. Don't ride or go over your credit limits. So don't max up your cards and just keep on reducing it enough so you can max it up again. And certainly don't go over credit limits. They do give you some leeway sometimes, but it's very temporary. So don't do that as well, because that's going to be reported. Pay down your debt. Keep your revolving credit limits low. This is one of those things that when somebody's looking at your credit bureau report, they're going to see that this person, although they have a lot of credit they've been granted, they're really doing things in a prudent manner, and they're trying to keep their debts as low as possible. If you have any cards, I say, because they always change, there's always these offers, transfer your balance over and do this and do that, whatever. If you move from one credit card company to another, close that card yourself, the one that you're moving from. Do not let the credit grantor close the cards, because if somebody looks at your credit bureau report and it says account closed by grantor, sometimes that could have a negative connotation. Maybe that company or that business didn't want to do business with you anymore for some reason. It's just not going to look good. So if you close the card personally, again, it's showing and it's giving evidence that you're managing your credit responsibly. Don't open up multiple accounts over a short period of time. That may look like you're trying to accumulate a lot of credit over different institutions because one institution didn't grant it to you. So again, we get, I know myself personally, I get tons of offers in the mail on a weekly basis. Just because somebody's offering you something, that doesn't mean you need to take it. So, opening up credit over a short period of time generally looks to be not a good sign to lending agencies. And be focused when you look for credit. Not all credit cards and not all loans are equal, right? Sometimes there's some misleading information, that's not, untrue, but the way it's presented makes it look like something else. Some credit that you get, especially from some places, are just enormously high interest rates. So again, be focused when you look and look at all your options that are available to you before you go with one agency, with one lender. So I mentioned the credit reporting agencies. In Canada, there's essentially two. There's Equifax and TransUnion. Not all financial institutions subscribe to both of these. Sometimes you'll look at the TransUnion report and it'll contain things that the Equifax doesn't have. And sometimes it'll be vice versa. The Equifax report will show things that the TransUnion doesn't have. But it's important to make sure you're on top of it because, again, errors do exist in these reports. I've had mistakes on my own personal credit bureau reports, and I've had to clear those up. So it is important to stay on top of those. Now, you can get them on an up-to-date, on a really up-to-date basis by paying for a fee. You can subscribe to one or the other, and they will automatically show you your credit score and your credit history report and your payment report and everything like that. And they will also show you who's looked into getting your credit bureau report too as well. Right? And that's sometimes important to look at. But if you don't want to subscribe to it, both the credit reporting agencies are obliged to give you one free credit report a year on your request every 12 months. And that one's given to you by mail. So you have to ask for that in writing, and they will mail you out your credit bureau report. So, do yourself a favor, keep on top of your credit bureau report. Again, because if there's mistakes on there, it may affect your credit score negatively. Now, anytime a institution is looking to grant credit, they're basically looking at two things: your total debt service ratio and your gross debt service ratio. And, the total debt service ratio is really a bit of a preliminary assessment whether the borrower has at this point too much debt. Right? So what they'll do is they'll look at all your loans and lines of credit and your credit cards and any leases and everything like that, and all your housing payments, so your mortgages, your rents, your property taxes, heating costs. And if you're in a condo, they'll take 50% of your condo fees, and they'll add that all up, divide it by your gross income, and you'll get your total debt service ratio. The guideline maximum is about 40%. So if you have an acceptable amount of debt, it'll be 40% or less. Now, what they do go into next is, especially if they are looking at granting, a mortgage or or the like, they'll look at your gross debt service ratio. So they'll look at your housing payments right now, and anything as a guideline will be approximately maximum 32%. But again, these are just guidelines. A lender may make exceptions if they pull up your credit bureau report and your credit bureau report is nice and clean, looks good, has a great history, looks like you're responsible. So just because these guidelines exist, they are just guidelines. If you keep your credit report in good shape, then you may have get yourself a better deal on debt, and you may be able to get credit even though you are over these numbers too as well. So if you run your numbers, if your numbers are looking too high and your debt service ratios are too high, and you're only making minimum payments, you might want to look at a debt consolidation. A debt consolidation is combining several debts into one, and you're reducing your interest expense potentially by doing this, right? By reducing your interest expense, more of your money is going towards paying off that debt. Again, when you want to strengthen your balance sheet, cash flow is the engine, remember, and you want that engine going towards boosting your net worth, and boosting your net worth is one way to boost your net worth is to pay down your debt. And upon the payout of all these, you may get a lower monthly payment, and you'll increase your own personal cash flow. So the additional cash that you're saving, because now you're not paying as much, you may put towards other things to meet your financial priorities. And what this will do, it'll also increase your net worth more quickly. So if we look at an example here, we have a client who has a low interest rate Visa and has a $3,000 balance. So they're making a minimum payment of $90. They have a MasterCard, which is about 19%, which is standard for MasterCard, about $2,000 on that. And they're making a monthly payment of $60. And they have a line of credit for, pretty expensive line of credit, but they do have a line of credit somewhere at 10%, $5,000, and they're paying $150 on that, right? So really, if you're making the minimum payments on this, which is a total of about $300, your balance after 3 years is pretty much the balance that you have today. All you're doing is really financing that debt, you're really maintaining it. You're not reducing it at all. But if you look at a consolidation loan, and let's say you're able to offer security, let's say a secured line of credit on your home or on real estate, or you have some other way of getting a better rate for yourself, and you're looking at a loan at about 6.15% on $10,000, your monthly payments are still going to be the same. But after 3 years, your debt's going to be paid off. So again, you've just increased your net worth without changing your cash flow at all. So these are some strategies that one can do. And sometimes, depending on your debt, you can also free up additional cash flow. Again, not everyone's situation is the same. So if you want to work this through, working with your account manager at the closest rapport branch that you're at, or somebody you've been working with already, is a good place to start to see if you can free up some cash flow. So we've looked at reducing the debt side and looking at the cash flow aspect of planning through life stages. Let's look at on the investing side, on the asset side. And one of the stages that many people embark upon, especially obviously if they have children, is saving for a post-secondary education. It's not just, and the thing is, there's a bit of a misconception that some of the accounts that are out there, and we're going to focus a little bit on RESPs today, that only parents can set this up. This is not just available to parents, but grandparents, relatives, even friends can set up an RESP for a child. So if you're a grandparent and you want to make sure your grandchildren have money for their post-secondary education, this is a great way to pass that money on to them, where they can use that for post-secondary education. And also, it can be a very effective form of estate planning too as well. But it's important to look at what the options are. So let's look first, why it's even important to save for post-secondary education. Well, let's look at the cost. Really, the average cost for a post-secondary education in Canada, and this is from pretty recent data that came out from Stats Canada this past September, across Canada right now, the anticipated cost for next year is about $6,800. That's just pure tuition for a full course load. And that's an average, right? In Ontario, the average is $7,920. And we can see over time, although it has fluctuated, over time, this has got pretty expensive. And I'll tell you how expensive it is. When I went to post-secondary education, my full course load back then was $1,400. I know that was back in the Stone Age, but we still know that education costs do go up. Now, looking at tuition, you may look at this and say, well, it hasn't increased all that much over the last 5 years, but where the big costs have happened is living expenses. And any student who studies, doesn't live at home is going to incur all of these expenses, and even some who live at home are going to incur some of these expenses too as well. So from various sources, we went out and looked at what the average expense would be for let's say a student attending a post-secondary education in the Greater Toronto Hamilton area. Housing, and this is on-campus housing, so we're not looking at third-party housing. On-campus housing is approximately about $11,600 per year, right? And that's just staying in residence. That doesn't include any food plans or anything of that nature. If you want food, if you want to eat, you're going to have to pay another $4,200 a year. Clothing and the like, about $1,200 a year. Transportation, about $960. Books and supplies, on average about $2,500, but depending on your program, if you're in a science program or if you're in a program at a college where there's a trade where somebody has to purchase tools or equipment or that sort of thing, that can be way more expensive than that. So it depends on the program itself and any miscellaneous expenses. No, that doesn't mean beer money. That basically means other expenses that one occurs through incidental expenses through going to school. So we're looking at another additional $22,000 of expenses. So if you couple that with tuition, it basically costs $30,000 a year for a child or a student to go to attend a post-secondary education, and who's away from home in the GTA and Hamilton area. So if you're living at home, you're still going to have some transportation costs, clothing costs, maybe not as much food costs, but you'll have books and supplies and miscellaneous expenses as well. So it's going to be anywhere between $20,000 and $30,000, which is a realistic number. So this is why it's very important to plan for post-secondary education. Now, the most popular way that most people plan for post-secondary education is through an RESP, or a Registered Education Savings Plan. Now, looking at an RESP, there's some basic rules involving the plans. You can have an individual plan. So for every child or person that you're planning for, they have their own separate plan. Or you can have a family plan. So if you have multiple children, they can all participate in the same plan. And that plan can be owned jointly between parents or grandparents, or it can be owned individually. They can be the subscriber of that. And the subscriber is the owner, the contributor of the plan. So again, as I said earlier, it's not necessarily limited to the parents. It can be grandparents, other relatives, or even friends. So anyone can really set up this plan for the benefit of a child as well. The beneficiary is the child of the student or the children of the student, and the promoter is the institution that offers the plan. So, up until probably the mid 1990s, maybe the mid to late 1990s, there was only specific RESP companies that offered these plans. And the reason being is, quite honestly, they were a terrible way to plan for education. If your child didn't go to a post-secondary education, they pretty much lost all the money that was contributed in there. So they were a horrible way to plan for post-secondary education. But what happened was, back in the mid to late 1990s, the federal government overhauled the RESP program, and they changed the rules in regard to them. So now the contributions to the plan are set fairly specifically. So the annual limit, although there is no annual limit, the lifetime amount that you can contribute to each child is $50,000. And the contributions, unfortunately, not like an RSP, are not tax deductible. So you aren't getting a tax deduction for doing so. But the benefit, though, is the growth that accrues within these plans are not subject to taxation while they stay within the plan themselves. And the other benefit, and this is the huge benefit, the government also will give you a grant depending on the amount of the contribution, and also even give you an additional grant if the child comes from a family with a modest or low income family as well. So you have the Canada Education Savings Grant. We'll get into the details of that. Even the Canada Learning Bond. This is money that the government, even for low income families who have no, don't have the means, unfortunately, to contribute to this type of plan, if they apply for it, they will still get $500 up front and $100 a year for that child to go into education. Although, as we've seen, it's not a huge amount of money, even if it grows at a fairly good rate over time. What will happen, though, at least it's something. And so, and very few times can I think of that the government basically gives you money free so essentially it's always a good idea to take advantage of this, even if the person says, I don't have any money to contribute to a plan, I can barely make ends meet right now. You should apply for it still. Some provinces even have some additional savings programs available to them. It depends on the province. Because most of our members are in Ontario right now, we're just going to stick to what's available to Ontario. So talking about the grant, this is the free money that the government essentially gives you. So from up until 1998, the government gave you nothing. So you were entirely, dependent on your contributions to how much the child was able to use for post-secondary education. From 1998 to 2006, the contribution was $400 per year under the grant. That was the maximum contribution. After 2007 and beyond, that contribution was raised to $500 per year, which is essentially 20% of the maximum of $2,500 per year, the amount they contributed. Now, when the student gets to age 16, a couple of special rules kind of apply. So it's one of two things. To get the grant, the person either has to contribute $2,000 in the prior year to which the beneficiary turned 16. So obviously you have to contribute at least $2,000 to get the grant at age for the contribution in year 16, or you've had to contribute at least $100 a year in any 4 years prior to the year the beneficiary turns 16. So again, to qualify for the grant, the bar is pretty low. So, if you're going to put in a lump sum when the child is 16 to get the maximum grant, just keep in mind that these two rules have to be met for the grant to be awarded in those 2 years. And the reason the government has done this is essentially because they don't want people kind of putting money in to get the grant and then taking it out the next year, right? So they want it to go towards education. Now, the basic Canada Education Savings Grant is 20% of the annual contributions, and the maximum you'll receive in any year is $500 per beneficiary. The government will also let you make up room if you didn't make a contribution the prior year. So let's say you put in, you missed the contribution for the prior year, and the following year you put in $5,000. Well, you'll still get the entire grant for the prior year too as well. But the most grant that you'll ever receive in total from the government is $7,200 per beneficiary. Now, again, looking at that, you say, well, it's not an awful lot given the cost, but you know what? Remember, this is over time, and assuming this amount of grows over time, it can grow to a fairly significant amount of money. Now, a few years ago, the government brought in additional programs for people who had modest, low or modest incomes. So the government said, we'll give you an additional 20% of the grant on the first 500 if the family income is less than $50,197, and we'll give you an additional, and if the annual income is between $50,197 and $100,392, we'll give you an additional 10%, not 20 plus 10, but 10%. But again, it's going to be subject to the maximum of $7,200 per beneficiary. So if we look how this works in practice, let's say we have a net family income of less than $50,000. So the Canada Education Grant on the first $500 of the contribution is going to be 40% or $200. And the amount on between $501 and $2,500 is going to be 20% or $400. So the total maximum grant they're going to receive is $600. Right? And if we look over towards those who have their income between $50,198 and $100,392, we'll see that the total grant is $550. And if your family income is over $100,000, the total grant that you're going to receive is the basic 20%. So again, looking at the way this works, if you have family income, and this is on the family of the child. So if a grandparent is setting this up for, let's say, a grandchild, this is based on the income of the parents, so not on the income of the grandparents. So again, it's a good way to get additional money potentially and to contribute to a child's post-secondary education. Now, when the money comes out in two ways. There's an educational assistance payment, and that's paid from the growth and the grant portion itself. And this money is taxable to the beneficiary. The beneficiary has to be in a qualifying educational program, and that's either a full-time, which is 3 weeks or 10 hours per week, a program that's more than 3 weeks or 10 hours per week, or a part-time program where the program is more than 3 weeks, but it's greater than 12 hours a month. Right. And the limit on the EAP in the first 13 weeks of enrollment, so it's in the first year, again, the most you can get that you can get on the EAP is $5,000. And if it's a full-time program, and $2,500 of this payment if it's a part-time program. You can take as much out as you want from the other portion, not the growth and the grant portion, but from the contribution portion in the first year. But you're limited to this amount in the first year. And again, this was set up so the program is not used as a tax dodge, but really as a program to finance post-secondary education. And again, that $5,000 in the full-time program, that'll be taxable to the beneficiary, the child, and not the subscriber. The refund of contributions, so to make up the rest of the payment, can be taken out in any quantity and in any amount, and that's non-taxable. These are the amounts that were originally contributed by the subscriber, and it can be paid at any time. Again, it may be subject to RESP terms and conditions. Some institutions place terms and conditions on withdrawing that. Usually those are nothing more than showing proof of enrollment in a post-secondary education, but some other institutions have some crazy terms and conditions too as well. The accumulated income payment that's paid from the growth of is taxable to now if the child doesn't take post-secondary education, what happens is the grant has to be paid back, and any of the growth on the grant or any of the money that contributed in there is taxable to the subscriber. So if money's taken out before then, it's taxable at their tax rate plus a 20% penalty tax. So again, this was set up so these plans are not a tax dodge, but to pay for post-secondary education. Now, if the child doesn't attend post-secondary education, they can still get money out of this other than the grant being paid back. The principal can be refunded. The contribution can be refunded back to the original subscriber, and anything that's left over in there can be rolled over into an RRSP as long as that child has the allowable RRSP contribution. So again, these are there's a lot of rules that are involved in this, but certainly it's something worth looking into, and we can certainly help you if you have any questions in regard to that. So if we look at a typical student who's let's say was born today and is going to school in 2040, which would be when they turn 18, you can see that and if they're just contributing the $2,500 a year and their post-secondary expense is $7,920 a year, and they're looking at withdrawing $10,000 of the EAP, so that's the amount that that's the grant and the growth, so that's the amount that's taxable to the child. And generally, if they take out $10,000, they're not going to end up paying any tax anyways, because most kids don't have enough income to hit that minimum threshold of paying income tax. So, through the withdrawal period, in that pink period, we'll see how that money comes out. So it'll be EAP plus a refund of any contributions, which are non-taxable. And even if they do that, they'll still have funds left over afterwards. So in this example, this student would be able to take out more should they need additional income. Or they can use the remainder that you can see after that pink period if they decide to go to graduate school or to take some other program that qualifies after that post-secondary education. So again, there's a lot of options available to one, and it's important to know what those are going forward. So let's shift gears here a bit and let's look at retirement. Now, retirement is, again, a topic that pretty much all of us have to plan for going forward. But the goal is anytime you plan for retirement, it's retirement on your terms. You ideally want to get to the point where you can stop working if you want to, but you're not continuing to work because you have to. So that's, retirement on your terms, on your income, and in what retirement looks to you. And again, that's going to be different for everybody. But for most people, this is what their retirement income is going to look like. And for a lot of our members who are part of the Ontario government or the civil service or Crown agencies, a lot of their income is going to come from their employment pension. For those who don't have an employment pension, that portion is going to have to be made up for savings. So that part of the pie is going to have to be bigger for those who don't have a pension, looking at a pension in retirement. Those who have worked will be getting CPP and old age security. And remember, CPP is a contributory plan. So based on your work history, and if you've taken breaks off for raising children, that is actually, that doesn't work against you on your CPP benefits. So again, it's important to know those figures, and old age security too as well. So looking at it, these are basically the 4 areas of retirement savings that we could be looking at going forward. Now, for those people, and again, because many of our members come from the provincial government, they're looking at either an OPSU pension plan or the public service pension plan offered to the Ontario Pension Board. These are pension plans that are guaranteed and inflation protected income for life. Now, the inflation guarantee usually is about 8%. So they will adjust those payments by up to 8% a year based on the inflation rate. Anything over 8% is usually carried forward to the following year. Your unreduced pension is essentially 2% times your salary factor times the years of pensionable service, less any CPP integration if you retire prior to age 65, right? So you have to look at that amount too as well. And if you take an unreduced pension, so if you're able to retire early, you hit your factor 90 or your factor 60/20, or you reach age 65. Those are usually the factors that contribute to taking an unreduced pension. And that number is going to be different for everybody. Canada Pension, you can start that as early as age 60, although a reduced amount, or you can delay that to age 70 and get a larger amount. The delays have been introduced recently, and they're good tools to look at because you don't want to be collecting your pension and then which has pushed you into a higher tax bracket, and then you wind up pretty much taking your the additional pension that you received, you're just paying that back in income taxes. So, and as I said, Canada Pension Plan is based on average earnings in Canada. So, the maximum that you can receive right now, based on this year's number, is $1,253 per month. Very few people receive the maximum, because to receive the maximum, you've had to essentially been working for 40 years and paid the maximum contribution into your pension, into the CPP every year. Most people don't work for 40 years. And if they do work for 40 years, at the early part of their career, they either have part-time jobs or lower wage jobs, entry-level jobs, where the percentage does not hit the maximum CPP ceiling. So most people will get something less than that, but there can be people who do get pretty close to it as well. Old age security is a universal pension. It's available to everyone in Canada. And again, you can take that as historically at age 65, that's paid out, or you can delay it to age 70. It's based on residence in Canada. So you've had to live for a number of years after age 18 to receive the full amount. And the full amount at age 65 is $754.05. Again, if you delay this, you can get a higher amount. But the other thing that you have to remember too for old age security is, because it's universal, you can be clawed back on that pension amount too as well. And we'll discuss later on what that clawback amount is. And generally, the clawback starts at around $79,000, and you're clawed back $1 for every $15 of income that you have over that. And once you reach, I believe the amount is approximately $109,000, your pension, your old age security is pretty much all clawed back. So again, everybody receives it, but not everybody keeps it. It's based on income too as well. And again, there's ways that you can plan your income and some strategies you can use as a retiree, such as income splitting or pension splitting, where you can pay less tax as a household, but also report less income and have your old age security clawed back less, or even not at all. But again, these are strategies that we discuss with members on a one-to-one basis. When your RSPs, so looking at RSP accounts and saving for retirement, if we're looking at savings, there's different types of investment vehicles that one can use for savings, and and as you can see, they're not equal. All of them have different levels of growth potential to them. They have also different potential volatility attached, and they're all taxed differently. So again, it's important to have investments within your retirement savings and that makes sense for you, that you're comfortable with, but also that they're located in a way so you're not paying any more tax than you need to be. So asset allocation and asset allocation are very important concepts when it comes to retirement planning. And for when you take money out of an RSP, well, let's look at RSP specifically. When contributions are tax deductible, and the growth is not taxed, so the growth is sheltered. But when you take money out of an RSP before it's switched to a RIF, there could be withholding tax, right? The only exceptions to this are the first-time home buyers plan, where you're allowed to take money out of your RSP to finance your home if you're a first-time buyer. There's no withholding tax on that. Also, the lifelong learning plan, where you're allowed to take money out of your RSP to finance post-secondary education. That's not taxable as well. Now, I say it's not taxable because the government wants you to contribute back that money, and you have a time period to contribute it back. If you don't contribute it back, then it becomes taxable. And it becomes taxable not at these withholding tax rates, but it becomes taxable in your overall income in that particular year. So it's important to know the details of those plans if you're going to take advantage of them. Now, the annual contribution limit to RSPs right now is about just over $29,000, less any pension adjustment. And a pension adjustment it only applies if you're part of a pension plan. And this is basically takes into account the money that you've contributed to the pension plan, and a very complex formula is applied to it, so that whether you're part of a pension plan or whether somebody's not part of a pension plan, they have the same amount of contribution room to an RSP. So there's no advantage given to one or the other. And any unused contribution room is carried forward. So if you don't contribute the maximum in any guarantee in any specific year, that amount is carried forward. When the money comes out of an RSP, you can either collapse it, so you can deregister it. I've been doing this 30 years. I've never seen anyone deregister a significant RSP in their retirement. That would be the most expensive and way to go. You can move it to a registered annuity, which may make some sense now. That's an insurance product, and depending on where interest rates are, that could be an alternative. Or by and large, by far, most people go into an RRS, Registered Retirement Income Fund, or RRIF. And you can basically change an RSP to a RIF at any age. Minimum payments are established by schedule, and that's basically dependent on your age. So you can see all the percentages there. If you're taking money out of a RIF, before age 71, you see that amount, how it's calculated to there as well. The other thing, another account that many people are using is a tax-free savings account for retirement, or they're using it for emergency savings. But again, this is an excellent vehicle to kind of top up on your RSP or your pension plan. Your maximum annual contribution is $6,000. As for 2023, that's been raised to $6,500. It was just announced earlier this week. You have to be over the age of 18 to contribute to have an RESP, not RSP, TFSA. Sorry. Like an RSP, the contribution room accrues if it's not used. So if you were born after the age of 1991, born after the year of 1990, before the year of 1991, rather, you can, and have never contributed anything to a TFSA, you actually have about $81,500 that you can contribute to a TFSA right now. So again, you don't want to give up that room, because not only can you hold the same investments, although a lot of people think when they hear the word savings account, they think it's just a bank deposit account. You can have any investment that you have in an RSP, but the benefit of this is the growth is tax sheltered. And when you take money out of this account, the withdrawals are not taxable either. So again, this is an excellent vehicle to supplement your retirement savings, and basically keep your taxes down too as well. And again, that's all part of maximizing your cash flow. The less tax you have to pay, the more cash flow that you have available to you. So in closing, we covered off a lot of material today, and we could go a lot longer, but we just wanted to touch on a couple of the few points of planning in different stages in one's life, whether you're starting out, whether you're doing estate planning, whether you're even doing retirement planning. We wanted to touch on some major points, but it's important to be informed. And certainly if you want to get additional information, here's a couple of online resources that we think are excellent places to go to. We have Equifax and TransUnion, which we talked about earlier as well. Credit Canada, and that's website is wrong, just take off the Equifax Canada after that. That's my error. But if you go to creditcanada.com, there's some excellent stuff there to educate yourself on credit. Investors Education Fund, Get Smart About Money. That's through the Ontario Securities Commission. Excellent place to go to about managing money. And the Financial Consumer Agency of Canada. If you want to see how long it's going to take you to pay off debt at a certain rate, there's some great calculators on that site. And it'll give you some additional insight into your financial well-being. And of course, there's always us. We deal with this stuff all the time, and we've seen a lot of members, and we've helped a lot of members at different parts of their lives to help them not only have retirement on their terms, but achieve all their other financial goals on their terms as well. Our personal account managers and wealth advisors, they'll work with you to understand your unique situation and outline any strategies that may make sense for you. Again, we want you to be successful financially, and we feel that the best way to do that is to be an informed consumer and have all the options available to you before you make a decision, and make a smart choice about which at the end of the day is your money. So on that, we'll end the presentation, and we'll open up the floor to questions, and we'll see if there's any questions out there.
Oh, thank you very much for that presentation.
You're welcome.
I don't see anything coming in the questions,
Okay.
so we can give it a minute or so.
Sure.
Again, if anyone who's been viewing today has any questions and you think of it after, reach out to us at help@rapportcu.ca. Again, just a reminder, thank you for everybody attending. You have been entered into a draw to win $100. We will be having another webinar next week. I believe, Michael, is that when life throws you a curve?
That's when life throws you a curve, and
Yes.
and hopefully one of my colleagues will be presenting, and we'll have one in 2 weeks in regard to working with a financial advisor, and why that's an important thing too as well. Again,
That's
these
great.
yeah.
Perfect. We do have a question, and this is from Sarah. Can you have a mortgage when you retire?
You can. It's not the ideal strategy, but what's happened though is the reality is more and more retirees are carrying debt into their retirement. And so you can do it. Can you apply for a mortgage? Even possibly. Again, it all depends on your credit, your credit bureau, and your and those 4 C's that we talked about early on, the capacity and the like. But certainly that's a great question. If you are contemplating doing that, that's a great thing to talk to one of our account managers about, to see what that would look like in your situation. You'll have $100,000 left. Yeah. That it's not uncommon these days for people, you know, if we were having this discussion 20 years ago, it would be, that would be the exception rather than the rule, but it's not so much an exception anymore. People still have $100,000 left. And, you know, again, you know, your sources of income. So if you're receiving a pension and you've got fairly predictable sources of income and you're able to carry that comfortably, then yeah, there's it's not an issue. Ideally, you'd like to not have it, but the reality is, you know, sometimes that's not possible. So that'll happen. But thank you for that, Sarah. That's a great question.
Thanks, Sarah. Do we have any other questions from the audience today? Yeah, not seeing anything come through.
Okay.
Again, Michael, thank you so much.
Well, you're quite
And
welcome.
we'll see everybody back next week.
Hey, thank you all and have a great rest of the afternoon.